As Jitendra, good to have you with us here. Thank you very much for your time. Uh, the one space which continues to attract a fair bit of attention from both investors and sell side is banks. But it's the kind of attention which is not leading to any significant outperformance, yes, as of yet. Everyone is talking about it, but I'm not sure who's buying it because I guess everyone owns it. What's the way out and what's the road ahead in that sense, Jitendra, for the space? I'm talking about the top 2-3 private sector banks.
Yeah. Good afternoon, Prashant. It's good to be here. So if we see, I think as you mentioned, the reason is that since everybody owns it, and if you look at the nature of the incremental flows, especially on the MF side, if you see, most of the flows have been concentrated in the mid-cap and small-cap stocks or funds. So obviously, the reason to buy large banks there will be very limited. And as a result, we've seen that the sector has not attracted flows per se of late. Add to that, there are other reasons also, like, for instance, the couple of larger names like HDFC Bank and ICICI Bank. They are nearly approaching 10% limit, which as an investor, a lot of us can hold as part of any of our schemes. Which is also perhaps acting as a constraint in terms of further buying, which is likely to happen in some of these names. But if I look at the overall attractiveness for the sector, I still find it one of the most attractive sectors within the space. If I take into account the long-term growth potential, the ROEs, the quality of franchise, and also the earnings growth and valuation which these franchises are available at. It's like you're getting good mid-teens ROEs with mid-teens growth potential at mid-teens valuation. I think that's a very, very attractive proposition for a long-term investor. So we continue to like large banks, and we are definitely holding a buy recommendation there, or we remain placed very favorably there.
Jitendra, afternoon. Reema here. You want to quickly tell us, walk us through your portfolio construct, which would be the big overweights, where are you underweight currently, and if you've done any portfolio churn in the last 3 months?
So not too much of a churn in the last 3 months, Reema. But if you see in terms of overweight, obviously financials are one overweight sector in our portfolio. We also like autos, though we are playing more through the ANCs rather than the OEMs there. We also like some of the consumption names, though at this point in time they are beaten down. But we expect that as we turn the quarter and in Q3, we are likely to see resurgence there or some kind of a beat demand there. And that's where I think we'll start looking at these stocks performing. In terms of our underweight, obviously IT sector remains one of the underweight for us as a house. And again, I've said in the past also, that what we have seen is essentially that the earnings have not bottomed out there in terms of the sequential flows. And yesterday's Accenture commentary again defends that view for us, especially given the very weak outlook which they have given. It also has implications for the IT sector for here as well. And if you look at the valuations, they're already at 15 to 20% premium to the historical averages, long-term averages for the sector. So that's one sector we are underweight at this point in time.
All right. Well, Jitendra, we are heading into the Cricket World Cup, right? And there's, of course, a frenzy in terms of whether you talk about hotel bookings, flights, everything seems to be full. Ad rates are surging as well. So I wanted your thoughts on a couple of these pockets of consumption. One is the QSR stocks, where you have the Jubilants, Westlifes, Zomatos of the world, the platform companies, which have done very well up until now. And the other is the hotel stocks, like Lemon Tree, Indian Hotel, Chalet, all up about 30 to 60%. Have investors missed the bus, or do you think there's more to go for some of these stories?
For some of these stories, obviously, there is a much bigger long-term runway for growth, Sonia. So, for instance, talking about QSR, if you see the frequency at which Indians will be eating outside will be still one of the lowest across the world. And also the sheer amount of distribution expansion which some of these names can undergo is still very large. So the opportunity there is pretty large in my view, and it's a multi-year opportunity. Obviously, You can take a look at the valuations from time to time and decide where you want to be present in. But QSR as a space, we definitely like as a house, and we have a reasonable overweight on that space as well if you go through our portfolios. Hotels also, they've done very well over the last few years. However, we think that, again, the valuations there are now on the higher side compared to the historical averages. And we may see some kind of consolidation now, especially when we see that some of the near-term triggers, like what happened in terms of travel post-COVID, the World Cup, the G20, all these demand triggers go away. And then we are back to the normal situation.
Jitendra, burgers over pizzas?
I think that's the consensus for everyone.
But why is that? Actually, I'm asking, why is that? I mean, it's not. I'm not sure it is taste tests or anything, but is it down trading? Because I mean, because of inflationary impact. I mean, people, it's affordability. Yeah,
it's not really that, because if you see the offerings for a pizza, we have a pizza starting at $70 compared to a burger which perhaps starts at $40-50. The price differential is not that great, Prashant, in my view. I think what's happened is perhaps given the familiarity with pizza space, or the expansion on the pizza space has happened much earlier for us as a country compared to, let's say, burger, which is happening now.
Okay. So when you said your overweight consumption, clearly QSR is one theme that you like. Hotels, you believe that they're in for some consolidation. We may not see that big upside like we've seen in the last couple of months. What about your traditional staples, the FMCG names? This quarter, we're likely to see some margin tailwinds. But where do you stand on FMCG?
So as a house, we have a very neutral kind of position on the sector per se. What we like about the sector is the kind of stability it provides to the overall portfolio and the diversification it helps us achieve. It's a sector where we believe that the earnings growth will be on the low double-digit side over a longer term. So whenever you are at a valuation point where you see that they start becoming attractive, you try to get into the sector and then rotate out of it when the valuations start pricing in a lot. So right now we see that the valuation of the sector are drifting towards a attractive point, and I think maybe another quarter or two of underperformance, and then we may see that we will perhaps try and see if we want to add a bit more on this side.
Okay, since you guys are talking about pizzas and burgers, right? What about beverages? I mean, United Spirits, United Breweries, all of that. That's also been surging quite a bit, and we are heading into a long weekend, so I guess everyone has their plans ready. But how are you feeling about that, Jitendra?
So that's one sector, Sonia, where we've had limited position from time to time, and I think it's also to do with the lot of regulatory noise around that sector, which we see from time to time. So clearly, we look for a much higher margin of safety in this sector when we look to invest here.
Okay, all right. We will let you go on that note. Thanks a lot, Jitendra, for joining in and giving us your views. Appreciate your thoughts. By the way, the market looks like it's going to have